Humans have a strange obsession. We think if we stare at something chaotic for long enough, we can predict what it will do next and get rich in the process. Economist John Maynard Keynes called this the castle in the air theory. He observed that many investors completely ignore what a company actually produces and instead try to predict what the crowd of other investors will do. It relies on a very specific strategy, the greater fool principle. You buy an overvalued asset, wait for the hype to peak, and then sell it to someone even more foolish before the inevitable collapse. And historically, those castles always collapse. When the pool of greater fools dries up, the panic sets in, wiping out fortunes in a matter of days. When we treat the market like a psychological puzzle to solve, we aren't actually investing. We are gambling. We pay massive fees to expert fund managers, buying the illusion that someone somewhere is in control. Princeton economist Burton Malkiel spent his career studying these experts, and he arrived at a blunt conclusion. Wall Street professionals have absolutely no idea what the market will do tomorrow. He popularized the concept of a random walk in finance. It means that the next step a stock's price takes is completely independent of its last step. Knowing it went up yesterday tells you precisely nothing about whether it will go up today. If the stock market is truly a random walk, the entire industry of highly paid stock pickers and market forecasters is charging billions of dollars for a service they cannot actually provide. The first method is technical analysis. Chartists study peaks, valleys, and trend lines to predict upward movement. But Malkiel showed a chart determined entirely by coin tosses. Heads up, tails down, looks exactly like a normal stock chart, complete with false, readable patterns. This aligns with the weak form of market efficiency. By the time a pattern is clearly established and visible to everyone on a chart, the window to profit from it has already closed. Technical analysis offers the comfort of geometry, but it provides zero actual predictive power for your future wealth. The second method is fundamental analysis. Here, analysts crunch hard numbers, earnings, growth rates, dividends, to calculate a stock's true intrinsic value. But mathematical models cannot account for reality. Markets are driven by sudden, emotionally charged real-world events. A geopolitical shock, a corporate scandal, a technological breakthrough. These are random events that alter the economy in an instant. This brings us to the efficient market hypothesis. Think of the stock market as a massive, hyper-connected network. When new information drops, the market absorbs it and adjusts prices so quickly no human can exploit it. Because new information is by definition random and prices adjust instantly, picking individual stocks is a futile exercise. Over the long run, active stock picking is virtually guaranteed to underperform the overall market. So if we can't beat the market by drawing lines on charts or predicting earnings, how do we invest our money without losing everything? The academic answer is modern portfolio theory, an approach that abandons prediction entirely and focuses strictly on managing risk. The theory splits risk into two categories. Systematic risk is the danger of the entire market dropping at once. Unsystematic risk is the specific danger of a single company going bankrupt. The market only rewards you for bearing the systematic risk of participating in the economy. You do not get a premium for taking on the unsystematic risk of betting on one specific company. To succeed, you have to mathematically neutralize that individual risk through extreme diversification. True investing has nothing to do with finding the perfect stock. It is about building a portfolio that isolates you from individual failures. The most effective tool to achieve this extreme diversification without paying high fees is a passive index fund. Because index funds rarely trade, they simply mirror the overall market. They avoid triggering capital gains taxes. More importantly, they guarantee you capture the exact growth of the overall economy. You then manage your remaining risk through life cycle asset allocation. A younger investor can afford to hold volatile stocks, but as you age and lose the capacity to weather a sudden market crash, you steadily move your money into stable bonds. The final step is dollar cost averaging, persistently investing small, regular amounts over decades, completely ignoring the noise, the hype, and the daily news cycle. Long-term wealth building is boring by design. It requires abandoning the ego of trying to pick the next big winner, cutting out the fees we pay to Wall Street forecasters, and simply trusting the math.